Pensions and other large institutions increasingly turning to risky leverage strategies as illiquid investments such as private equity prove unfruitful. The risk of forced liquidation hangs overhead. Here to discuss is Brandon Yarckin, who is the Universa Investments Chief Operating Officer. All right, so first and foremost, let's break down some of the risks that you're seeing right now and kind of the thesis around and how investors can perhaps mitigate some of that own risk.
Yeah, sure. Thank you very much for having me, Brad. So I think it's important to take a step back, and so our opinion will have some context, right? So, Universa Investments is a risk mitigation firm. So all that we do here at Universa Investments is think about and optimize risk mitigation. So clients will come to us and we offer them this kind of insurance-like payoff where we lose a little bit of money when nothing is happening, or we lose as little as possible, and then in crashes we try to make as much as possible. So we get this reputation of being kind of perma bears, always looking for the next black swan, right, like the black swan behind me. But that is a bit of a misconception, because in reality a lot of our clients use us to be long or even longer than they would be otherwise. Going back to 2022, we were probably one of the few large-scale and institutional investment firms that was tactically bullish. We went as far as putting out a broad communication to all of our clients in 2022 through Universa CIO's decennial letter, where we noted that the market was likely to go vertical because we were very concerned about sentiment being so negative, and sentiment needed to flip on its head before we would likely see a crash. So what have we seen in the period since? The market is up 50% or more, depending on which market you're looking at, and sentiment has certainly started to change. While we're always out there looking at things like private equity, as you mentioned at the start of the question, I think that that misconception of people thinking that we are always permanently bearish, when we've actually been one of the few firms that has been bullish for the past 18 months, hopefully should give it some context.
So Brandon, what could potentially trigger this? And when you're talking about a massive correction within the market, more specifically, what does that then look like?
Sure. So again, now that we have this context of portfolios that are built a certain way, we look at the financial landscape as being incredibly leveraged, right? There's a tremendous amount of debt. We also put this in our communication to clients about how much financialization and leverage has caused debt levels across corporations and governments and the like to be as big as they've ever been. And we've seen the Federal Reserve raise interest rates as quickly as they ever have. So that has specific lag effects, and one of the most visible lag effects that we've seen is on private equity. So private equity, we don't get visibility into the Blackstones and Apollos and Carlyles and the big private equity firms. What we see are people that are invested in those firms. We are risk mitigation for those people, right? For the large public pension plans, for the sovereign wealth funds. They come to us as experts, right, to help them to look at these big systemic risks that are lurking, and how they can best fix them. And so with private equity specifically, what we've seen is just a growing portion of illiquidity on institutional balance sheets relative to liquidity. And by that, I mean, institutions such as pensions, sovereign wealth funds, and the like have fixed liabilities. What does that mean? That means that every year, a pension has to pay pensioners, a foundation has to pay grants, a university has to pay teachers, right? So they manage money, but a portion of it they can't touch because it's with a private equity firm, or it's in real estate, or it's in something that's difficult to sell. Yet every year they actually have to sell things to make these contributions to their stakeholders. And after this big push to be in illiquid assets, because illiquid assets arguably have higher returns, they have this volatility smoothing characteristic where they don't, stocks, you see your P&L every minute, right? I'm sure a lot of your viewers are out there watching their stock portfolios as they trade up and down over the course of the day. These illiquid assets, you might not know what they're worth for a year, right, or more. And so what ends up happening is that portion of liquid assets has continued to shrink as private equity monetizations have been negative. I'll pause for questions because I know that's a lot. But
Well, actually, you just triggered a thought here, because even as we're thinking about some of the pension fund managers and the investment kind of hat that they have to wear in order to make sure that they are kind of getting into more liquid assets here, or perhaps rotating into more liquid assets, where are you seeing them initiate perhaps the largest, most sensible trade right now? What is the positioning that many of them are adding on over this past year, and how does that set up for kind of longer term growth of some of those funds?
yeah, I mean, it's a great question. I mean, we obviously see what we see directly are people utilizing tail risk hedging as a means to help them with these potential very large illiquidity risks. So what happened in 2008 for a lot of private equity firms is institutions ran into this liquidity issue because of different, financial products that they were overinvested in. They add to other problems through things like securities lending. So what they want to sell, they can't even necessarily really sell in a crisis. And so they come to us and say, hey, what is the most effective way that we can generate liquidity in a crash? And, traditional portfolio construction would say, okay, well, you need to have 40% of your assets in things that are liquid, like treasuries or maybe liquid hedge funds or things like that. And what you found is because of this kind of commonality of investment process through institutional investors, they all have the same thing, and they've all underperformed or generally underperformed their benchmarks. They're all some level of underfunding is endemic across pension plans specifically, and it's because every time there's some worry lurking, they end up in the wrong thing. They end up in something that is going to lower their risk, but it also lowers their returns. And one of the things that we really try to educate people on in terms of portfolio construction, and what our CEO wrote a whole book on this called Safe Haven, which I'd encourage people to read, basically says there's lots of ways you can insure your portfolio against risks, but at what cost? And most things that you do in portfolio construction have been much more costly than the risk itself. So tail risk hedging, the way that we do it, is the only form of risk mitigation that we found that's been cost effective. And those are the things that people come and look to us for.
All right, Brandon, we got to leave it there. Brandon Yarckin, Universa Investments Chief Operating Officer. Thanks.
Thank you very much.